Hey guys, Freaky Finance here. We're still in the middle of this earnings season, so this is probably hopefully the last maintenance video I'm gonna do. But some of these companies I don't own, unlike the last video where I owned all of them, and just kind of show you different things that are going on at different times to different companies in different industries. So anyway, booze is an interesting one. So this is Diageo's annual. They actually reported annual back in June, but anyway, liquor on one hand has been doing very well, especially spirits. At-home drinking has increased during COVID. Basically, it's the good that unlocks an experience. That's kind of how I'd view it, especially on the luxury side. Has done quite well. So the share price has done quite well. I don't own this one, but I thought it would be worth mentioning right here. On page 17, you can see higher spirit prices. Their higher tier items grew 9 times faster than the normal average tier items. So basically, all I'm saying here is that luxury items in Diageo has picked up. And again, that fits the narrative that people on the luxury side spent a lot on goods during this last COVID year. And what I'm expecting in this next part of eventual recovery is the increase from the transition from spending on goods to the transition to services. And so now the question is going to be, which services can I go long that don't have too much labor inflation, and if they do, can I pass it on? So that will be an interesting kind of angle that I'm going to go for this next quarter, try to find companies like that. I'm already in quite a few because those things have also lagged. So the goods have already performed quite well. Here's like these bottom 5 right here. Buckle, Claire's, Capri, Designer Brands, and Nordstrom are all goods, right? These are all active positions, and they all sell physical items, right? So eventually what I need to do is transfer these ones into services, right? But right now, a lot of them are cheap, right? Capri is the only one that's really run. So Nordstrom has earnings this week, so we'll see how they do. But so far, a lot of the retailers are doing quite well on the good side. But again, that's what I'm trying to say, is a eventual rotation out of those at some point. But I mean, still probably early. A lot of these haven't actually recovered in share price, even though their businesses are actually doing better than pre-COVID. And some of them actually took advantage of COVID. Cineplex is an interesting one. So this is on the Canadian side. And anyway, I want to bring this up because their quarter on Thursday during Remembrance Day was pretty interesting. So they started finally breaking even on EBITDA. This is a weird metric, but basically add back their operating leases. The margins, this business is actually interesting. I'm probably going to do a video on this at some point because it, again, fits into the experience recovery play. I do own this one. It's right up there, CGX, some call options. Again, really, I'm just playing to recover them, hoping that happens in the services industry this year. The reason why I got in and why now, basically on their call that they just did. Let me just pull up the Word document. All right, so anyway, you can see right here, when compared to pre-pandemic levels, July was 38% only. They opened halfway through July, most theaters in Canada. And then August, you got 62, September was 67, and then you had 80%. And then they said on the past weekend, they had the highest box office since the pandemic started, even exceeding the same weekend in 2019. So that's pretty bullish. I mean, there was a lot of good movies out lately all at once, so that helps drive as well. And again, on the experience side, which is what I'm trying to focus on in this video, is the BPP and the CPP reached all-time highs. So this kind of tells me that the people that are going to the movies want the experience of the movies, but are spending more at the movies as well, at the concession side. So that's their food. So the movies, I want to say, I'll go through the video in more detail, but basically margins are about 70% for food in the movies, and they're hovering around 50% on the film side as well. So there's a gross margin, not operating margin. And anyway, all I'm trying to say is that there's people that are going to movies are spending more at the movies for the experience of going to the movies. So it's a cheap way to get out of the house, really, and do an experience. So that's why I'm looking at Cineplex and why I have a call option position in it. During the another reason why is I listened to the hearings, the Cineworld versus Cineplex hearings, and it's in a Canadian court, so I think it's going to win favorably for Cineplex in some degree. We'll see though, which could be a material mover for the stock in a binary way. Though, I mean, if it's a big win, they'll just appeal it and take it up to more international waters for litigation. But anyway, here you can see that even though, like I said, it went from like 30% to 60% to 80% in October to actually hitting 2019 box office levels in the latest November week, the share price has barely moved in this 12 to 15 range this whole time for the last 6 months. It's actually down if you're going to go 6 months out. So has the recovery partially been recovered in the stock? Yeah, probably. Because at one point it was at $5 when they weren't sure if this company was going to make it at all, right? You have covenants having to get waived. This company has quite a bit of debt, so it's a leveraged way to play a reopening, and the balance sheet hasn't improved during COVID, right? This company still was burning cash, and I think it still burnt cash this latest quarter, though it looks like it's going to start turning it around in this Q4, but we'll see. But anyway, I thought this company was interesting as a way to play a recovery in experiences in Canada. Up here is kind of an outlier. This is tied to the Cineworld acquisition, so they're about to get bought out for $34. And then during COVID, like when it hit, basically Cineworld said no, the company has changed materially. So why would I spend $34 on a company that's now being impacted so heavily for COVID? And now that's what this litigation's about. I won't go into more detail right now about it because we've got a lot to go through, but it's an interesting case study anyway. It'll be interesting from a lawyer perspective as well, litigation perspective, what happens, because it didn't have the material event clause. That's kind of the angle that Cineplex is going. Interesting chart and an interesting way to play a recovery, because this thing could easily go back to 20, right? It was hovering in this range, and this is when I was paying $100 million in dividends a year. So I won't do that right away. It's probably gonna have to repair its balance sheet. Interesting times that we live in. Dufry reported a while ago. I thought I'd bring it up this time because I do have a larger position in it. It's my largest one. And the main reason why is that it continues to recover each and every month, and the share price is still just sitting there. Again, a part of that is Delta. People are impacted, but it continues to get slowly better. And so does domestic travel as well, but international is what you want with this one. And it probably will be the latest. International travel will be the last thing to recover. What I'm trying to say. You can see the growth rate versus 2019 Q3 is the black, and then 9 months is the red. And you can see that the last 3 months are far superior to the last 9 months. So continued growth. A better way to show that is this chart right here. And you can just see that North America, Central America, Eastern Europe, Middle East, Mediterranean, they're actually doing quite well. We'll have to see. Case counts are going up in Eastern Europe again. But, you look at this recovery over time in most of the market. You have Asia down here, which only represented 6% of the sales going into COVID, so it's not really material. So it will be material at some point. That's why I think this is going to be a long-term position, a long-term recovery play. It was during the last Great Recession as well, though obviously international travel is more impacted by a pandemic, so it might be slower, but right now it looks really good. And importantly, they're actually etching out free cash flow, even though they're down 40% because they've pulled so much cost out. So even though sales are only 60% of what they were, we're still able to pull some profitability in terms of cash flow. Again, one of the main reasons, I'll probably put a link to the original video below, but one of the main reasons is they have sustainable reoccurring fixed cost savings of $400 million. They're actually executing on that, so it's already happening, so that you can actually see the business improve. And yeah, here's October net sales performance trends at 60%, so that leads into a good Q4 2021. The balance sheet is actually doing okay, so they actually bridged the pandemic better than I think the market's giving them credit for. You can see their debt's actually back to December 2019 levels, so pre-COVID, which is pretty interesting. And they do have a good debt maturity profile to weather any temporary more variant waves, whether that's fourth wave, fifth wave, sixth wave. So I think we're gonna sit pretty on this one. This one's not a call option play. This is just a long-term recovery play that I think is going to play out over time. And then yeah, you can see here the breakover. They keep bringing it up every quarter. They're actually going to do quite well in the second half, even at a minus 40%, which is where they are. October was only 60% of 2019 sales for turnover, but you can see just how profitable it is, even when it's only doing 60% of what it used to. I think that's not showing up. It's definitely not showing up in the stock price. I always look at transport. So this is CN Rail. I always find this interesting to see what's shooting up. You'd expect petroleum and chemicals, metals and minerals, coal. So energy picking up in transportation still. Most people look at transportation as a leading indicator. It's still showing strength in the energy market. So a lot of demand. So ultimately, it's from 2020 base, so it could just be lower demand in 2020, right? It's a little bit noisier, so you usually don't see these huge swings, right? Even automotive, and that's a different one. So automotive inventory continues to dwindle. Demand is still high, but they literally can't make the automobiles, so they're not getting the transportation on the trains. So maybe the automobile companies put up a weak quarter for Q4, mainly because Not because the people don't want to buy cars, they just literally can't buy cars because they can't build them fast enough. And then we see that in inventory in automotive too, it's just dwindling down. I thought that was interesting to point out, but yeah, that's what I usually look at leading indicators like transportation. All right, this was interesting on Sun Life's call because they still own power, right? I thought this statement was pretty interesting. For the first time, more than 40% of those deaths in the working age population, the highest rate of deaths in that population. Bring that up, not because mortality is bringing down Sun Life anyway. It obviously affects it because they're insured. I just thought this statement was interesting. For the first time, more than 40% of those deaths were in the working age population. Again, and we know the deaths are very linked to unvaccinated people, so it tells you that the unvaccinated working class are starting to die more, and that might also lead to more labor inflation. It's another angle to bring up, literally because there's people that used to work that are dying now, not just the elderly. That was in the first wave. Kind of unfortunate news, but I think that's worth bringing up because it's going to lead to that more labor strain because there's literally less people in the working age population. This was interesting. I'll just bring this up because I know a lot of Canadians own a lot of banks, right? Office of the Superintendent of Financial Institutions finally allowed banks to increase their dividends and once again repurchase shares. That was on November 4th, so that's going to be exciting so that'll be good. We already saw Sun Life increase their dividend. I'm sure Manulife will. I'm sure all these guys will. They'll have a lot of cash because their businesses are actually doing quite well. I just thought I'd bring that up. Just another thing that I saw this week. Someone's turned it into like a news thing of things I saw this week. Going through 10Ks. Anyway, this was interesting on McDonald's because I had a talk with somebody about inflation. It's showing up in the CPI now, but talking about how he's only seeing it in certain things. I'm like, no, I'm like everywhere. Anyway, this is McDonald's. They said they're increasing their prices 6% on the menu overall. The analyst asked them on it, and they're saying their customers aren't price sensitive to it yet, which is interesting. But I thought this sentence was the biggest eye opener for me because right now they said they're only up 2% in terms of inflation on their input costs, but they're already starting to increase their prices 6%. But you can see right here, we expect the full year to be 3.5 to 4%. And remind you, they're already 9 months in. So that tells you they're expecting quite a bit of inflation in Q4 on their commodities. And that could also be because they probably hedged some of that out. So they weren't realizing the full impact of the rise that we've seen already. Till now, they've already started to increase the prices ahead of that. It's a timing thing, but I thought it was worth pointing out that yes, we're seeing inflation in even more places. Yes, some businesses have increased prices ahead of time for the inflation, mainly because they've hedged out for that little bit of lag. Anyway, I thought that was worth just bringing up. Kinross is just destroying it in terms of the reason why I bought it, because of the fire, right? And it shot down. Their production cadence went from 2.3 million ounces to 2.1 million ounces, so 10% less. Anyway, they got the mine back up and running quicker and cheaper than what they originally guided. I mean, it's not going to be full production, but you can see they're planning to exit the year out decent amount of production. But more importantly, they reiterated the production guidance. So going from 2.1 million ounces this year to 2.7 million ounces next year, which is a pretty big jump, and then 2.9 the next year out. So Kinross production cadence is on track, so that's exciting for me. Yeah, and this is basically their slide, again, reiterating their production cadence, full recovery from the fire, and with their original expansion plans. Then you can see, this is their argument again, how cheap they are versus the industry. They have started buying back their shares, saw that this quarter, and you can see the free cash flow yield, basically. Kinross saying we are really cheap based on next year's free cash flow versus the average of the industry, which is, in my opinion, true. That's why I own it. So this is interesting. I'll probably end on cannabis because they had quite a bit of earnings and noise this week. So cannabis is actually my worst performer in terms of percent for this whole year. But the businesses continue to improve dramatically from where they were when I bought the security. So it's an interesting time when your revenue is going up quite a bit, double digits, and then you're also having favorable EBITDA, right? So a part of that scale. So you can see their margins now 23% versus 15% in Q2, while their growth revenues expanding. That's what scale would do. So that's what I like to see. This is Columbia's Care. Mainly I'm picking on this one because I did a video on it. You can just see how the business has improved quite a bit, right? Your adjusted gross profit last year was only 21 million and now you're at 64 million. So you've effectively doubled your gross profit while increasing the margin by 10%. And then obviously the adjusted EBITDA is kind of a ridiculous year-over-year comparison from Q3 to Q3 2021. You can see you're up 600% in terms of adjusted EBITDA. And this trend has kind of played out in other MSOs as well in the States. But it's an exciting time right now. So, and it's been a pretty much bear market for cannabis since February. One of the things that was interesting is November 7th, you had Representative Nancy Mace, South Carolina. The Republicans put up their own bill, allows safe banking to 280E, which is kind of the reason, if you go back to the Columbia Care videos, one of the main reasons why I think these companies over time are going to increase in value. And so what happened last year is Biden got elected and all these cannabis stocks got overexcited, right? Basically because of legalization. And then once the market started realizing, well, these guys aren't actually doing anything material for some time, it's been a steady sell-off every month, really. And so all of a sudden last week, there was a big news about this, right? All of a sudden the Republicans are coming up with their own bills because 66% of Americans, and Americans are usually divided on a lot of things, people in general are divided on a lot of things, but 66% agree that cannabis should be legal. So when you have that kind of agreement among your voting base, generally speaking, both parties are going to start jumping on this to get elected. And I think that's what we're seeing here. So it just increases the odds of some favorable outcome in legalization is how I view it, and that's probably what the market's trying to gauge. They did also, so currently there's safe banking inside the National Defense Authorization Act, and there was also this last week on November 9th, where I think it was 23 governors or 24. They all signed off saying, hey, you guys should probably approve this thing. Say 37 states, 4 U.S. territories have passed some form of recreation or medical cannabis. Basically, they're saying allow safe banking. And yeah, this will be important from a liquidity point of view, right? Just to give capital to some of these guys so they can actually expand the business at a cheaper discount rate. That's how I view it. Interesting times going on in cannabis, but the main reason why I want to point this out is that it's not trading on fundamentals. These cannabis stocks are trading on legalization, so it's almost like a political it's a way to bet on political policy. So the timing will be fun, but you're never probably going to get that right because you're not in control, and it's not like my cup of tea, right? I like to look at financial statements. You'd expect that a company that's 600% better would be a more expensive company, but it's not, so at the specific time. So I'll have to see what happens, but interesting times all around. Somebody watching this, all I know is eventually legalization will happen. Something like the Safe Banking Act will pass. 1080E will be removed, and eventually they might even have full federal legalization, but at this time you don't even need that. You just need these slow, steady, favorable political events that are likely to happen at some point. Anyway, that's all I had this week. It was kind of like a news flash week in a way. But yeah, have a great rest of your week. I'll probably do more of like a normal company next week, depending if I have time. I got a lot of Chinese companies as well reporting. It's busy season. Anyway, have a good rest of your week.